huge down day today. Down 11,000 or so. It's May 18th. And I'm doing a video log because I'm trying to get to 1 million from 30K. Now, after I take you through the account and give you all the fun stuff and show you how the account has been performing or not performing, I'm gonna lay out the bear case for a company called Tattooed Chef. So stick around for that if you're interested in the bear case. And also, it's not just gonna be the bear case. I'm gonna outline some things that are true for a lot of growth companies. Actually, I should even check how Tattooed Chef is doing today, but all in good time. I'm down 11K, actually about 12K, 11 and a half from when I filmed the video yesterday. So big down day, that's for sure. So I'm gonna run through the positions real quick. I'm going to present you with the options, all the information you need about the options right here in this little box. So just feel free to pause the video at any time and review the information, figure out my exact position. The numbers on the right represent the daily change in percentage, and below that it's the the percentage. So the dollar amount and then percentage. So I'm going to scroll through it quickly. Feel free to pause. Lots of Chinese company leaps in there. That's where most of the losses are registering. Apple had a huge down day. 5.5%. I couldn't resist it. Actually bought a few shares of Apple. I had sold 5 yesterday. I bought 10 today. So I do believe that it's coming to close to fair value. I pinned my fair value for Apple around 125. So it's coming down, but I don't think it's going to reach that level. If it does, I may do something pretty unprecedented and actually sell off a lot of positions that I own. Almost everything, whether it's a losing position, winning position, options, whatever, and just funnel it into Apple at that price so I can take advantage of that deal. So moving down to the other equity positions, JD was down almost 5%. VIPS holding up very strongly, surprisingly, only down 0.5%. And then Realty Income was the other somewhat relative winner on the day, down only 1.2%. Main Street Capital was down 4%. I picked up a few shares of that, about 10 of them maybe. Goldman Sachs down 2%, relatively strong compared to the market, which was down 4%. So S&P 500 4%. And then Smith & Wesson was down 6%. The only green on the day, Diddy. Man. So I only have 60 shares. Obviously, I just mainly want to see what happens when they voluntarily delist from the New York Stock Exchange and listen to Hong Kong. What will happen to my shares? Will I get OTC shares? OTC means over the counter, which means they're traded outside of an exchange in between brokerages and banks. Or will they become something else entirely? I don't know. Or will I get the money back? Will I get cash back for the shares? Or will I be compensated at a higher price? I don't know. So I want to find out what happens there. So that is the account. If you want to see the performances, this is the weekly performance here. Up 7%, monthly down 10, 3 months down 15, 1 year up 5% still. And all time it's 120 now. It was quite a bit higher. At the peak, I was up 177%. Now this looks like a flat line because for years this account only had a few $100 in it. I started doing this challenge about 2018, so you can start the graph from right here if you're interested. This means that I've added about, total of $72,000 from the beginning. But some of these gains were done with, $30,000, $40,000 initial investment, and then I've added more, right, up to 72. And but the way percentages are worked out is from that base, so the performance is actually kind of better than 120%. Was 135 or something like that yesterday. Anyway, so that is the old chart. Daily chart down 6.44%, definitely losing to the market, any kind of index. So that's unfortunate, but that's my account so far. I'm gonna go into the Tattooed Chef analysis here. So when it comes to growth companies, I only think that a very, very small percentage of them make it. A lot of them look promising, and it's very difficult to judge growth companies. I have a hard time doing it. I try to, because that's where most of the money was made in the last decade or so. But it's hard to pick a winner. Like, it's very difficult to say, oh, this one's gonna be the next Amazon. Why wasn't Pets.com the next Amazon? So I mean, obviously some people can spot that out, but there's a lot that goes into it, and looking at the numbers can kind of give you a signal of where the company's headed. So this company's been very popular on the internet, so that's why I want to do a little bear case analysis on it, and tell you why I'm not buying it. So I'm gonna go to one of my favorite sites, which is stockanalysis.com. It's free, and I'm gonna look at some financials metrics here. Currently, it's trading at 687. The stock was down 6.4%, in line with my account. So we're gonna look at quarterly instead of annual. We're gonna look at quarterly metrics, mainly because the company's only been public for like 3 years, and so it's gonna give us a better picture of what's going on. Number one metric that is important for growth companies, of course, revenue. So if we look at revenue, you'll see that there was an initial bump here at the open whenever the IPO'd, and then it's been steadily rising, plus or minus a quarter. And this looks pretty good. However, when we dig in deeper into the numbers, you'll see that that's not actually that good. I have the 10Q pulled up as well, so we can take a look at some of those numbers. I want to show you some interesting figures. So cost of revenue, the graph looks very similar to the revenue. Gross profit, they're actually losing money, but so one thing that immediately stands out to me here. Oh, there you go. So operating income. You want to look at the operating income, and it's not doing very good. Now, obviously, they had a big expense somewhere over here. Let me see. There's a better graph for it. This one right here. Other expense and income. Obviously, they had some kind of expansionary expense. Probably. I'm not sure what the event was, but it's not really relevant. What is relevant though is this number here that I'll show you, and it's outstanding shares. Okay, so if you bought in 2019, right, you were basically holding 1/10 of the size of the company that you were holding back then. Okay, so that's kind of typical for growth companies. They like to issue shares, but that share issuance has to be substantiated, right? It has to correlate with an even greater expansion in the business. Okay, so if they're diluting the shares, they need to be using the capital to generate more revenue. But what's happened with this company so far is that even though the shares have 10x'd, right? So if I owned 1% of the company in 2019, I'm now owning 0.1% of the company, right? So in essence, my shares should be worth $1,000 instead of $100 per share, let's say. But we don't see that kind of revenue increase. The growth companies are judged basically on revenue, on sales. But we don't see that 10x, right? If we go back to the revenue on the quarterly, where's the 10x? Let's say we start from the lowest number in March 2020. It's 35. Now it's doubled to 72. It's not really 10x, And this trend doesn't look to be accelerating too much. I mean, it does look tiny bit exponential, but not nearly as exponential as the share issuance that this company is embarking on. So let's see some other figures. Operating margins. Yeah, I mean, this kind of stuff is expected from growth companies, so it's hard to put down negative on that, but yeah, these numbers definitely don't look good. As a principle, I generally don't like to invest in companies who can't show that they can make a profit. That means that their company has not been okayed by the market. So the way it used to work, right, or the way it's supposed to work, is you have a proven product that you have a profitable company that's a certain size. Maybe it's local, right? And you're making money. You go to the investors and say, hey, look, I want to scale this to the entire nation or even globally. Let's make this into a public company. Let's get all this capital inflow and open up, Slav's burger joints, uh, everywhere. I don't have a burger joint. Everywhere in the nation or the world, right? So I take all this money, I open up spots everywhere let's say in the nation, and they'll become profitable over a certain period of time. Yeah, there's going to be growing pains associated with employment, building, plant equipment, machines, things, training employees. There's going to be it's expected to have initial outlays that are very large, right? And you're going to be losing money for a while until eventually the grease kicks in the gears and the store turns profitable, just like Slav's burger joint was profitable luckily. Maybe I need a different company name. But anyway, so this is how it used to work, right? But unfortunately nowadays the company doesn't even have to show profit to go public. It just needs to show that it can increase revenue. But anyone can increase revenue. I mean, at what cost, right? If I pay you $60 to buy my product for $50, like, you're making $10 off of me, right? Anyway, I can go around, every single person in the world would take that deal. I can theoretically expand my revenue, up to, I can have 7 billion customers tomorrow, right? But at what cost? So that's the important. Are we seeing like these numbers turn over? These graphs have to like cross at some point, and it doesn't look like for this company it's happening right now. Look, I could be wrong. There could be some kind of event that people are waiting on, but I don't need to know much about the company to figure out like that this is not something I want to invest in. Okay, so let's take a look at some more numbers and figures here. I have pulled up the 10Q. If you're interested in official statements, what you need to do is just go to sec.gov. That's the website of the SEC. Alright, this episode's full of unintended personal self-indulging humor. So, you can take a look at all these numbers, read them line by line. I mean, they're important. But one thing I want to just bring attention to everyone, okay? So you can't see you can't see anything. Let me unlock this. We'll make it a little bit. Okay. Alright, so on the right here, this 261 million and 267 million, that's total assets. So you can check that out on your website as well. You can see a better view. But those are the total assets of the company. So the one on the right is December 31st, 2021, and the one on the left is March 31st, 2022. So when there's a Q by the statement, that means it's quarterly report. So they compare it to the previous quarter basically. And you can see that there is a decrease in assets, but at the same time, you would expect a decrease in liabilities. However, the total liabilities, this is the number of total liabilities here. I'm sorry, this is it. So the total liabilities actually went up. So assets down, liabilities up. So, I mean, I know it's just quarter over quarter, but it just really stood out to me that it's like, okay, well, something's not actually adding up. Like, either this is kind of like a really big work through period, or doesn't make much sense. So anyways, but you can read through the entire statement and go through the numbers and see if it makes sense for you. But I like to look at it just because I'm a very visual person. I like to look at it already input it into a website like stockanalysis.com or Finviz or something. But the problem is that sometimes these inputs aren't correct. I'm not saying the stock analysis has faulty inputs, but sometimes it may not actually make sense until you look at the numbers themselves. So, anyways, the bear case of this company is that it may work locally. It could be a case of one of those companies where, just like Slav's burger joint, right? If I expand it outside of my immediate area, the entire nation may not like my burger. Maybe it's just very localized. I'm super successful, let's say here in, California, but maybe people in Texas or people in Louisiana, they don't like my burgers. They have a different taste. And so all that money that I borrowed, right? All that stock that I sold, ownership of my company that I sold publicly, and used all that money to expand actually ends up crashing down on me. And it happens on many companies, especially food companies, especially companies that are niche like restaurant businesses and things like that. So we'll see. I mean, let's see how Blue Apron is doing now. What do you guys think about that? Let's check out Blue Apron. Let me see if I can revert. 1 sec. I need to revert this viewing experience. All right. So Blue Apron. That was pretty popular, like, I don't know how many years ago. Am I spelling it wrong? Oh, the Apron. I don't know how to spell Apron. Apparently you spelled it with an O. Okay, so it's $3.30. Let's see how the stock price did over its entirety. All right, so it's a slow grind here. Let's take a brief look through the financials here. Well, this is really dead, right? Revenue is actually, it's had a slight increase over the last 3 years. But let's see at what cost. I wonder if, let's see, operating income. Oh, man. Let's see the shares. Outstanding shares. Yeah, look at this. They just keep issuing shares so they can keep the company afloat, and the revenue is pretty static. So this company needs a major catalyst to turn it around, or it's just dead. I mean, I'm surprised nobody's taken private yet, or just they might get delisted if they stop issuing shares out to keep the company afloat. But yeah, it's really bad news. I would never put my money there. So that's the case for Tattooed Chef. Could it happen? Sure. I give it about 3% chance of being a booming business like what people expect it to be. And actually make money over the next 5 to 10 years. Maybe less than 3%. All right, I'm going to leave it at that. Hopefully you guys had a better day than me in the markets. All right, if you did, I want to hear what your percentage up or down you had today, because I'm just really curious how people did today. I did terrible. All right, that's it. Peace out.